When we're talking about valuation discounts, let's kind of
Hmm.
go over that real quick. So basically, what a family's trying to do is for gifting purposes, they're trying to depress the value of their assets, right? They're
Hmm.
saying, hey, look, we have these assets. It's worth $20 million on paper, but in reality, in the market, it's worth less because we want to get some kind of a valuation discount for lack of marketability, lack of
Hmm.
control. Talk to me a little bit about what that looks like, or what are they trying to argue here?
Yeah, well, what they're trying to argue is that if you have a minority interest or even a non-controlling interest, if we were looking at a limited partnership where the limited partner can have a 99% economic interest, but they don't have that 1% controlling general partner interest, even that 99% interest can be afforded discounts for lack of control and marketability. And especially it depends on how the organizational documents are written up. They can say in there, you need unanimous consent, supermajority. Sometimes they just default to whatever the local state, LLC or limited partnership acts may specify, and which again that can get interesting if we have to start fishing for information. It's drags on the process. But through all of that, if you have a minority interest, more than likely there will be some form of restrictions on the sale. You can't just say, hey, with your poker buddies and say, I kind of want to offload this interest. Who's interested? And it's done like that. It's there's always some form of process and protocol when it comes to transfers. And so with that, if you own a 49% interest in a $20 million company, you can't just turn around and sell it for, that 49% interest. And so with that, what we have to do is start looking at discounts that would induce a willing buyer to meet with the willing seller so that they could come and meet, more or less halfway and, determine the fair market value, which accounts for those discounts.
Yeah. And just to be clear, the IRS hates valuation discounts, right?
Not necessarily. If you start getting pretty liberal with some of the arguments that you make, they will certainly question you. In the 6 years that I've been doing this so far, I have never had the service, call BS on our methodologies or, the total discounts. And that, you can have a discount for lack of control, a discount for lack of marketability. If one's 10% and the other's 20%, that doesn't necessarily, it's not additive. You don't just get 30% discounts. It's actually going to come out to be a little bit less because it is multiplicative. There we go. And so a lot of times what we'll focus on is the total discount that accounts for control and marketability, not just one or the other. But yeah, in some cases, depending on the factors that affect those discounts, you could argue a total discount of about 50% for a given interest, and the IRS may, raise an eyebrow to it. But if you provide logic and economic, sound economic theory behind it and reasoning behind it, they may ask a question, but they're not necessarily going to come knocking at your door saying, hey, we think something's going on here or anything, inappropriate in that way. So,
and part of that is maybe because you do have that ASA designation, you are following the rigorous standards there. And so when you do claim a discount, it's legit discount versus people trying to just come up with a number without the right qualifications, right? And when we're talking about an IRS challenging a valuation discount, keep in mind that, and we could talk to an attorney about this, but when you're taking a discount, depending on how you claim that discount, either as a percentage of, let's say, a discount as a percentage of the business versus an actual dollar number, right? You might have huge tax liabilities if you get an adverse ruling. And so it becomes really, really important that you get the proper valuation done. So put you on the spot here. So we're 2022, right? We're 3 years out. Just for fun, would you say most people are going to wait until the last 6 months, last 3 months of the year before they start seeking out services?
It's, I think the standard business interest holder probably will end up waiting until about 6 months beforehand.
Yeah.
And when they realize it's going to take 10 months before anybody could get around to it, maybe they learned the lesson when it first came out, in 2017. and they're a little bit better about that. But people tend to be people, so
Yeah.
I think that'll be how it plays out.
Yeah, and Jack, from our perspective, it's not just getting a hold of Justin to do his work.
Right.
It's we're busy as well, and there aren't that many qualified attorneys and advisors and valuation experts. So I would say 2 years ahead of time is probably a good start.
Information contained in this podcast and accompanying video have been derived from sources believed to be reliable. This content is not guaranteed as to its accuracy and does not purport to be a complete analysis of the topics discussed. Analysis is based on assumptions that may not come to pass. None of the content should be construed as legal or investment advice. You should consult with a qualified professional before implementing any strategies discussed. All expressions of opinion reflect the judgment of the speakers on the date the video was recorded and are subject to change.